Hello, chart watchers, and welcome to this Wednesday, March 7th, Market Watchers live show with your hosts, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. So far in today's action, you can see the Dow Jones Industrial Average down 273 points, down near the low of the day. The S&P 500 down not quite as much on a percentage basis, but still down about 19 points, hanging just above its 20-day moving average. The NASDAQ on a relative basis doing much better, down only 31 points. And the Russell 2000, which has been showing some nice relative strength of late, actually still up 1 point, although it is down quite a bit off of its earlier high. 10-year Treasury yield continues to consolidate, down just a little bit less than 2 basis points, sitting at about 2.86% right now. The volatility index, while it is up, has been in a downtrend since hitting that 26 level just a few days ago. The XLV healthcare doing fairly well on a relative basis. All 9 sectors are lower at last check, but on a relative basis, healthcare holding up okay. The medical supplies group, we've talked about this recently. Just a few days ago, we saw a reversing candle come in. We have now made a big move up. The group is still up today, even though the overall indices are down. But you can see we're challenging both the 20-day moving average and gap resistance on medical supplies. I think with a positive divergence in play, though, we could see a move right through that gap resistance area. The XLK technology also performing pretty well on a relative basis. I think at last check, that was actually the best performing sector, down 0.32%. Software trying to make a breakout. Just recently, we saw yesterday semiconductors making a breakout led by Intel. And now today, it looks like software trying to make the breakout. And on the flip side, I know energy is the laggard in terms of sectors, but I wanted to point out consumer staples also down today with the distillers falling from a key resistance area that you can see on this chart. I'm going to talk about that chart in just a bit. But first, let's bring in my co-host, Erin Swinland. I'm afraid I don't even want to talk to you this morning right now, Erin. I'll be honest.
Oh, come on now. I'm nice. Yes, for those of you who don't know, huge hockey fans here. Well, at least I am. And last night our teams played each other, and the Anaheim Ducks pretty much spanked the Washington Capitals. I think that's an okay word.
Yeah, we're running out of time for all the chit chat. We're gonna have to get into the show. Yeah, it was a beat down. I'll admit it. We lost 4-0.
We're pretty awesome in our home. So
yeah,
as we call it.
Yeah, I think it was 2-0 before the game started, based on what I recall. But yeah, it wasn't a very good thing. But we got a lot going on. We do have Martin Pring back with us today. How are you doing today, Martin?
Tom?
Hey, how are you doing?
I'm doing great, thank you. How are you? Are you all right?
Yeah, I'm doing great. I want to thank you for joining us again. We had such a great visit last time. It's always nice to have you on the show.
Thank you.
Martin's going to be getting into a lot. I know everybody's got questions, what's going on with the market. So Martin's going to give you his take in just a bit. We'll get back to that probably in about 10 minutes or so. But first, I'll let Erin go through the announcements for this week and into the agenda, and then we'll get everything started.
All righty. Let's see what we got. So this week, coming up, we have Tushar Chande. He's going to be here tomorrow. I know everybody's been excited to have him back. And Friday is going to be Tom's workshop. Currently, we're running a poll in the Slido app, and you can determine what you'd like his workshop to be about. He's put 3 topics up there. So go ahead and vote under the polls area. We're going to talk to Martin this morning, and we'll bring him on very shortly. 10 and 10 to 1 at 12:50. We are going to do Red Lion Hotels, RLH, as our first symbol. And then we're going to look at technical scans, a little bit about how to build them and what some of our scans are saying. And with that, I'm going to turn it back to you, Tom, for our technical news and headlines.
All right, sounds good. Here you can see the 10-year Treasury yield mentioned earlier. It is down a little bit today in the yield, which means money is rotating into bonds this morning. But still, the sideways consolidation that we've been talking about ad nauseum for the last couple of weeks continues. Really, it's been a month now that we've been trading. Well, the yield has been moving between about 2.8% to the downside and 2.95% to the upside. We got a pretty significant overhead resistance in terms of long-term yield resistance that sits up at about 3 to 3.05%. A few years ago, we hit that level. And since then, by the way, we've gone down in double bottom. So a break back up above 305, in my opinion, would be a huge breakout in the 10-year Treasury yield. But for now, we are simply just consolidating back and forth. We did get a pretty big employment report out this morning, February ADP employment report. 235,000 jobs. The market was expecting 205,000. So a beat there. It looks like the economy is continuing to keep its positive momentum going. Q4 productivity came in flat. The market was expecting minus 0.1%. So not a whole lot of a beat there. And then the Beige Book comes out at 2 o'clock. This is a report that comes out a couple weeks before the Fed meets. So I'm sure traders will be looking to see what is being discussed there in the Beige Book, and hopefully looking ahead to try to see what maybe the Fed might do at its next meeting. Wanted to go into a couple areas today before we bring Martin Pring in. I do want to talk about the specialty retailers. I mentioned them in my blog this morning. And first of all, you can see a huge cup off of an uptrend. I think that the fact that we've made it all the way back up to the right side here is very bullish. Certainly, it's better than what the S&P 500 is doing. So we are seeing relative strength. I mentioned in the blog article, I thought maybe we'd get a pullback to test this rising 20-day moving average. I think that could be great entry into a very strong part of the market. Now, I mentioned also in the blog I was going to talk about some stocks in this space. So let's talk about some of the names that have scooter scores up in the upper 25, 30% of all of the stocks within this group. And it always starts with Netflix. Netflix, huge move up. They did get downgraded this morning. I can't remember the investment firm that downgraded them, but they did get a downgrade this morning based on valuation. It's not based on anything negative. It's just when you get prices moving up like this, it's not a surprise to see a downgrade based on valuation. It was one of the reasons why I know we talked about the FANG stocks the other day and looking at individual stocks and which ones presented the best opportunities. The only reason that I didn't go with Netflix was because it's gone up so much. Just from a short-term standpoint, I thought there was more risk in Netflix. It is pulling back, but still looks great on the chart. 20-day test would be awesome if Netflix were to see it. Let's talk about some of the other stocks, though, that maybe don't get as much attention. Overstock, OSTK. You can see a trend line here that has been building for the last 2.5 months. Once that breaks to the upside, I think this could make another run. We have recent highs between about $68, $69. You can see the 50-day moving average comes in at 67. So a break above the recent highs would be your clue on Overstock that we might make a push back up toward that early January high. SFLY, this is Shutterfly. Another one within this space that has just been on fire. It's too far advanced for me to consider trading, but it is a great performer. I think when you look down, you see the volume, the huge earnings move. We got a little bit of a pullback, but it has been almost straight up, and it's been ignoring all the selling and the volatility that's been going on in the market. This thing just has its head down, continuing to move higher. HIBB, this is Hibbett Sports. And Hibbett Sports, you can see multiple tops trying to get through 26. Watch for volume to confirm a breakout on this one. CONN, CONN, this is Cons Inc. Another one that's coming up, testing these overhead moving averages, trying to get back through. Also notice that this 34 level has been big. We gapped up and failed on heavy volume at 34. We broke above 34. Look at all these tests of 34. And then when we finally broke down below 34, the volume picked up. Now here we are trying to get back up above 34. So 34 has been a big level on CONN. We'll see whether or not we can finally break through there. TUES, Tuesday Morning Corp, also making a move up, $3.40. So we're talking about a small company here, but it is one that's been performing well, has a strong scooter, and a breakout above 340 with increasing volume is something to watch out for. Best Buy, BBY. And again, for those of you just tuning in, just going through a lot of the specialty retailers because this is an area that has been outperforming the S&P 500 and on a potential pullback to put in a handle. These are some of the stocks that maybe are worth considering. Nice trend line here on Best Buy. Continues to hold above its 20-day moving average. I think it's only a matter of time before we do get back up here for a $78 test. TITN, which I believe is Titan Machinery. This one maybe, struggling a little bit more. I do think it's got great gap support down here at about 18 if it were to make its way back down there. But it had such a big move, it's taking a while to consolidate here. So it's not showing the same relative strength that some of the other stocks are showing. But again, I think the closer you get down to this gap support level, the better the reward to risk. 5, which is 5 below, you can see also trying to make a move back up toward its early January high, doing something that the S&P 500 is struggling to do for sure. And then I think it's 1-800-Flowers, FLWS. Yes, 1-800-Flowers. Big move. Look at the volume coming in on this push to the upside. Pulled all the way back, tested the rising 20-day moving average, and so far holding it. But that breakout above that recent triple top, I think, is bullish. Holding that rising 20-day is bullish. This one looks like it's still in pretty good technical stead. Just a couple more of these. CRMT, America's Car Mart, another big breakout, heavy volume coming in. The problem I have with this stock more than anything else is it's just not very liquid. When you look over here at the volume, you can see that these heavy volume days, quote unquote, heavy volume days, we're talking about 75,000 to 100,000 shares. That's not typically the type of stock that I would be interested in. So I would avoid it based on liquidity issues. But technically, I think the chart looks really good. And let's pull up one more. Let's do Home, which I think is At Home. Yeah, At Home Group. This one, I believe, could be putting in some sort of a maybe bullish wedge off of this high. Connect these highs, the lower highs, and then also the lower lows. I think we're kind of squeezing into a piece of pie, which is a bullish wedge. I expect eventually we're going to get a breakout here as well. A lot of accumulation taking place back at the end of November, early December. And since then, we've been mostly consolidating sideways, but I do look for another push here. And then let's take a look at the one other group. And this is in that consumer staples area that I mentioned earlier, the distillers and vintners. I want to show you, and I'm not a huge fan of consumer staples because they've been lagging, but I am a fan of technical patterns. And when I look here, I'm not getting it to come up. Come on. Well, it's not letting me use it, but here you can see what I think is a neckline coming across here at about 475. So you got an uptrend, left shoulder or left inverse shoulder, left side of the neckline. Here's your inverse head coming back up to the right side of the neckline. And so I think this weakness right now in this group is actually potentially setting up a really nice inverse right shoulder, which could take us down to somewhere between 455 and 460. That would make it very symmetrical with that left shoulder. If there's one downside, I would like maybe see a little bit more volume on this move to the upside. But the pattern itself, if we get heavy volume breakout above 475, that to me would be something worth keeping an eye on. Now, within this space, I think it's STZ, Constellation Brands, setting up very nicely as well. So here's your pullback. Here's the left side of the neckline, the head, inverse head, right side, and this one actually is holding up pretty well today, but any kind of a pullback to around the 216, 218 area in here would establish a right shoulder, an inverse right shoulder. And I want to show you one thing you can do, because for me, if I see STZ trading above 224, I'm going to want to evaluate the volume. So what I want to do here is just show you quickly. If you go down here to your alerts, I can set up, I don't use the alerts because I'm always on I'm always on the computer looking at stock charts and going through my own charts. But if you want to, if you're not, as active, or you just, and even if you are active, you may still want to use an alert. But I want to show you how you can use this. First of all, you can pick whether or not you want to be alerted by email, SMS, or the website. If it's the website, when you're on the sharp chart, you're going to see at the top, it's going to be a banner that comes across the top that tells you when your alert is triggered. So I could switch this to website and say STZ. When STZ crosses above 124, whoops, not 12,400. I'll be waiting a while for that one. But above 124, and then save the alert. And there you have it. So now I have a saved alert. So this is one way you can kind of follow. So it's going to come through and it's going to tell me when the STZ crosses that 124 level. I think it's a great tool at stock charts. Now, depending on your level of service, your membership, I think that impacts the number of alerts you're allowed. So I'm on I think I'm the pro member. So I get up to 100 of these alerts that I could set up. That's a great way to organize. I don't know about you, but I've had plenty of times where I've said, man, I wish I had, seen when it went across a certain level, because I see a chart. I know there's a key resistance level. I look at it 2 weeks later and it made the breakout and I didn't catch it. This is one way to make sure you catch it. So anyway, just wanted to point that out. And with that, I'm going to turn it over to my good friend, Martin Pring. I know, Martin, this has been a crazy market the last month, maybe about 5 weeks or so. A lot of volatility. How are you approaching the market here? Are you still bullish? Are you turning bearish? Are you waiting to see what happens? What are your thoughts?
Well, we're always waiting to see what happens, but basically my longer-term indicators for the U.S. stock market and for the global market are pretty well in a bullish mode. And it looks to me like, and I will get into this a little later, I think the bulk of this correction is probably over. And but if we start to take out the lows, then things become a little bit more serious, because that may affect some of the longer term indicators. Mm-hmm. But at this point here, I'm assuming that the trend is still positive because the indicators are still positive, and therefore this correction will act more as a correction within a bull market than a bear market.
So let me ask you a question then. If you have money to invest and you've been waiting for the market to pull back, do you feel like this is an opportunity to put that money to work?
Carefully, yes.
Okay. Are you going to define that for us, or are you just going to say carefully?
Well, just carefully, yeah. Okay. It's not like it was this time last year, for example, when everything was in green, so to speak.
Yeah.
Some of the sectors have started to give way now. So when I say carefully, I guess probably I mean more be selective, and be selective on the international markets as well, because they're not all doing as well as the U.S. market.
Okay. If you were looking at U.S. stocks and speaking about carefully, are you talking about maybe being more defensive in terms of the sectors? Are you talking about maybe getting into positions maybe over time, or maybe looking at the relative strength and trying to stick with stocks that are still winning?
Always relative strength. I'd rather not get into that right now, Tom, because that's going to destroy my presentation.
Okay. Great. I'm going to let you go. I don't want to destroy your presentation.
Maybe I'll destroy it. I don't know. Sorry.
No, go ahead.
No, I just said maybe I'll destroy it.
Oh, well, we know better than that.
Okay, no.
Go ahead.
Yeah, I'm not going to comment here.
Very wise. Very careful.
Yes, I always am.
All right, we'll let you take the screen and do whatever you need to do. Everybody's anxiously awaiting your thoughts today.
Okay, I'm not quite sure how I get the screen here.
Just that share screen button, that green button toward the bottom.
Ah, okay, it's just appeared.
There you go. Yeah, I've been waiting all week to get your comments, because we haven't had you on the show in a while, and a lot of things have changed. So I think everybody wants to hear what you are seeing out there.
Well, they certainly have changed. You can see my screen okay, right?
Yes, you're good.
Excellent. So what I'm going to talk about this morning is talk a little bit about the correction, where we've come from, where we are, and I'll show you some charts which I'm fascinated by. I haven't, years ago I never had them to use, but now I think they're very helpful on indicating confidence in the market, and from various aspects. And we see a lot of these confidence indicators breaking out on the upside above major downtrend lines or major resistance lines. And that suggests to me that the confidence is going to be going higher. And since the confidence indicators, when they're rising, are associated with rising stock prices, that's pretty good news to have. I'll also point out that if things don't work out the way I expect, some of the points that we would need to look for in case these indicators do not break to the upside, they start to break to the downside. Because we should always be flexible in what we're doing. I don't think we should ever be dogmatic. And then finally, I've got a few charts on what I call winners and losers coming out of the correction. And we look at some of those sectors along with their relative strength and so forth. So I think relative strength is a really important tool. By the way, Tom and Erin, if you have any questions or comments as I'm going through, feel free to interrupt me.
Absolutely.
So the first chart I have is my Dow diffusion indicator. This one monitors a basket of Dow stock, or not a basket, but a whole number of 30 Dow stocks. They're in a positive trend. And coming into the correction, it was fairly obvious when we were in this overbought situation at the end of January that some form of correction was probably going to happen. What was not obvious, and is never obvious, is the character of that correction. And it's certainly a lot more violent than I expected. But what we've seen now is a complete reversal, where instead of being overbought and bearish, the indicator is now oversold and bullish. It doesn't mean to say that we're going to run away on the upside, but it does suggest that the bulk of the downside activity has already taken place. And it's kind of like this situation, I think, over here back in the end of 2016, where we had a rally in the indicator from an oversold condition and then a secondary bottom which took place there. So I think probably what we're seeing right now is a potential secondary bottom in this indicator, and then I think it's going to be able to take off on the upside. The next chart shows the VIX, but this time what I've done is instead of showing you the raw VIX, which is pretty jagged and I find it difficult to follow, I've got a 10-day moving average, which is the black line, and the red line is a 15-day exponential moving average as well. And I've inverted the VIX so that it goes up and down in the same direction as the stock market. And again, we can use, when we take this indicator and we smooth it out, we can see some nice buy signals when it gets into a very volatile situation. Remember, it's plotted inversely, so when it's coming down, it means that things are getting more volatile. So when it gets less volatile and starts to move up again, that's from an oversold, overstretched condition. That's when we get one of these green arrows, which again fairly consistently point to higher prices. Sometimes you get a kind of a double whammy here, where we get a low here and then a rally and then another low, just like we did with the Dow Jones, with the Dow diffusion indicator in the previous chart. But and that seems to be what may be happening here, although the correction here in the VIX moving average is nowhere near as great as it was on the Dow diffusion indicator in the previous chart. But the thrust of these indicators is to the upside. And if this is a bull market, then I think you've seen enough of a correction, enough of a change in sentiment to say that these indicators are accurate in their reversal. If we were in a bear market or at the tail end of a bear market like we were in 2008, 2009, that would be a different assumption. And the character of indicators is much more different, or much different in a bear market, especially the end of a bear market, than it is during a bull market. So I think if my indicators are still correct and they're pointing to a bull market, then we've seen enough of a correction to allow prices, after maybe a bit more backing and filling and maybe probing at the lows over the next, I don't know, 2, 4, 6 weeks, then I think we're free to go on. If the correction lasts longer than that, and if we actually take out the low, then I think that possibly could start to affect some of the longer term indicators, and we'd have to take a kind of a different stance. So the next chart again shows the VIX, but this time I show the VIX in the bottom panel, the right way up in this case, and what we're seeing is a 10-day rate of change, because what we're seeing is a change in sentiment, not the volatility itself, but a momentum of the volatility. And you can see that every time it's moved above this green line, we've had some kind of a rally develop in the market, or alternatively, it's stalled the decline and allowed a sideways trading movement to take place for a little while, and then it's moved up. But the point is that when the 10-day rate of change of the VIX moves up to a high level and starts to reverse, the downside potential is generally pretty limited. Even in a bear market, this one here was 9/11. We saw a dramatic drop in the stock market, of course, in the S&P. and then a rally for several months before the bear market resumed. Well, right now we have this indicator at a record level, which tells me that, or suggests to me, that we've seen a very important inflection point here, and that if we are still in a bull market, then that represented a terrific buying opportunity. At the bottom is the VIX itself, and you can see it rallied too, but not anywhere near to the extent that the 10-day rate of change did. So the final indicator on the correction, I'll just explain it a bit with this chart here. And what we're looking at is an indicator. I call it my bottom fisher. And what it does is it looks at the Dow stocks and finds how many of the Dow stocks are in this position here, which I call the winter position, when the KST, or the momentum indicator we're following here, is below zero and falling. And is below its moving average. That's the winter position, because that's about as bad as you can get. So when a lot of stocks are in that position, that tells you you're in a very oversold condition and you're getting ready to develop a new bull market, or stimulate a new bull market. When it moves into the spring position, that's when the indicator is above its moving average. It's still below zero, but it's rising. So this next indicator I'm going to show you, my bottom fisher, monitors the number of stocks, Dow stocks, in the winter position and subtracts the number in the spring position. So as the number in the spring position gets larger, that means that there's more and more stocks able to move into a position with their momentum where they can support a rally. So that's the sort of the concept behind the indicator, and the next chart shows the indicator itself, which I call the bottom fisher. So in order to fish off the bottom, you've got to be very oversold. So the rule is that the indicator has to fall to this low, to this green horizontal line here at just around -30, and then start to reverse again. And that's when we get one of these green arrows. The dashed arrows represent failed signals, where you fall to the green line, you reverse again with more stocks moving into that spring position, but it fails to generate much of a rally. I mean, this is not a bad rally, because we're looking at 10 years of history here, so that's probably a couple of months of a rally. So at the time, you would have thought that it worked, but in retrospect, it's not one of these great. It didn't turn out to be one of these great buying opportunities, because the price came down again. And the same thing in the end of the bear market here in 2008. You got some buy signals, but it was in a bear market, and momentum indicators are nowhere near as sensitive to oversold reversals in a bear market as they are in a bull market. So you can see that during the course of the bull market, when the bottom fisher started to reverse to the upside, this gave you some really nice buying opportunities, pretty consistent too, on the upside. So now we get another buying opportunity, the first one since the spring of 2016. Again, indicating that, based on the idea that this is still a primary bull market, we've got a great buying opportunity here. So one of the reasons that I think it's a great buying opportunity is the behavior of some of my confidence indicators. And we'll go through some of these right now. The first one pits the Fidelity Growth and Income Fund against the Vanguard Treasury Fund. In other words, a very conservative stock fund against a very risk-averse Treasury fund. And the green highlights, or the green shadings, tell you, with the benefit of hindsight, we can set up when the ratio between the Fidelity and the Vanguard is in a rising mode. You may find some mistakes that I've got here, but by and large, you can see that, generally speaking, the low here and the high here is corresponding to the shading. And again, it's with the benefit of hindsight. The point being that if this ratio starts to break, and of course, when you got one of these green shadings, just look and see what the stock market's doing. It's always going up. And if the ratio is coming down, which is an unshaded area, that's the time when the stock market is most vulnerable. It doesn't mean to say it's coming down the stock market, because we have an unshaded period here where the stock market moves up. But generally speaking, when the ratio is rising, that's bullish for equities. And you can see that it's right at this green resistance trend line just here. in some respects, it's just broken out, but it's not really a decisive breakout. This trend line, just in case you can't see the dates, goes back 18 years and starts off in 2000. So it's a pretty big resistance level that it's trying to overcome. The next chart's going to show you the same ratio, but in a more recent period. So once again, we have the S&P in the top panel and the Fidelity Vanguard ratio underneath. And you can see that it's broken above this 2017 resistance trend line here. So when we look at its performance during the correction, you can see that the S&P made a high in late January and late February. It made a lower high, but the ratio made a higher high, which obviously is a very positive development, because it indicates that people are more interested in buying growth and income than they are in buying treasuries, and that means they're growing in confidence. So this is a stock market, bond market, inter-asset relationship. And as we go through these confidence relationships, you'll see that they come from different aspects. This is an inter-asset relationship. This next one here is a bond market credit spread. Again, it's reflecting confidence as reflected by bond market traders or investors, and that tends to spill over into the stock market. So in this case here, you can see that it's broken. This ratio here is the HYG, which is junk bonds, against the IEF, which is the 7 to 10 year Barclays Treasury ETF. So when the HYG is going up against the IEF, it means bond investors are growing in confidence. And when it's falling, it means they're losing confidence. But once again, you can see that this ratio here is just below important resistance until the beginning of 2018, and then broke decisively above the resistance, indicating that the trend of this ratio is likely to be up. And when we look at the correction, the way it's handled the correction, you can see that the S&P made a peak here in early February and a lower peak in late February, and the ratio actually made a slightly higher peak in late February than it did in early February. Essentially, it's going sideways compared to what the market was doing. So again, if I was looking for trouble in the stock market, I'd expect to see this red uptrend line being broken on the downside during the course of the correction. That would give me a red flag, but right now it's giving me a green flag, because even though we've had the correction with the S&P making lower high, people are actually at the same level of confidence or slightly higher at late February than they were in late January. So the thing I'm watching for right now, I'm saying that, okay, this indicator is bullish because it's above the trend line. It's above its 200-day moving average. If I'm looking for trouble, then I'm looking for this indicator to break below these two lows here, which will also cause it to break below the trend line, the green trend line, and the red support trend line, and eventually, of course, the 200-day moving average. So right now, I'm interpreting this as a bullish factor, and I'm expecting the trend of the ratio to go higher. But if it starts to break, that's going to alert me. And if the other confidence ratios I'm showing you start to break, that's also going to alert me to the fact that my assumption that the market's going to move higher needs to be further questioned. So we saw an inter-asset spread, we saw a bond market credit spread, and now the next one here is what I call a stock market speculation relationship. This is the SPHB against the SPHQ. Well, the SPHB is a high beta S&P ETF, and the HQ, the other one, is the S&P high quality. So when it's moving up, when it's rallying, that means people are going into the high beta, and when it's falling, that means they prefer to have the high quality because they're concerned about the stock market and they're concerned about the economy. Once again, we see, and it happened this week, a decisive breakout to the upside in the indicator. But again, we got our looking over our shoulder and saying, what would have to happen to turn this bearish? And that would be a break below this red uptrend line here, which would also, at this point here, break below the previous low. So it will be a pretty strong piece of evidence that it had broken down. But right now, it's breaking up, and it's broken up to a new high, whereas the S&P itself is not yet at a new high. Again, a very positive relationship. And when we look at the momentum at the bottom here, This is the short-term momentum here is bullish. Intermediate momentum is above its moving average, so that's bullish. And long-term momentum is also above its moving average, which makes it bullish as well. So all these confidence ratio relationships are looking at things from a different point of view. The inter-asset, the bond market credit spread, and then the stock market speculation relationship we saw here, high beta versus high quality.
All right, I do have a question out of the chat room. And the viewer says, will the bond stock ratio behave differently if the 30-year downward trend in bond yield reverses? Not favoring bonds might not be the same as favoring stocks, is what they've said.
I don't think it's going to. We're not really concerned with that because we're concerned with the trend of the ratio as it stands right now. So, although that secular reversal could affect it, it will affect. But the fact is, we're interested in the relationship between this indicator when it's rising or falling relative to the stock market. Does that make sense?
I think it makes perfect sense. Yeah.
Thanks.
Go right ahead.
So that was the high beta versus high quality. And now we have another one, which is the another stock market speculation relationship, which is one of the strongest ones of all. This is the technology versus consumer staples, XLK versus XLP. I didn't bring this chart in because I got a lot of charts to go through today, but this ratio here peaked in 2000, came down with a big, in a major way, and made a big base, which it broke out of in early to mid 2017. So imagine this is a big trading range going all the way back to 2000, and it's now moving to the upside. Again, what we're looking at is when the ratio is rising, it indicates investors have confidence because they're bidding up the XLK technology versus the XLP, which is defensive consumer staples. And once again, you can see the relationship between this ratio is making a new high, whereas the stock market made a lower high. And it actually made this new high, I think it was the end of last week. So it's a very strong relationship indicating that despite all the fears of this correction, trade wars, and so on, the XLP is still rising against the the XLK, sorry, is still rising against the XLP, which I think is very positive. So let's move along to the next bank here. Let's move along to the next bank. Okay, here we go. And then our final confidence ratio, which you can't plot on stock charts, which is my own. First of all, this is the S&P in the top. Second of all, underneath is my Pring risk-on, risk-off ratio. The risk-on, risk-off, remember we're looking at this from these confidence ratios from inter-asset, bond market, credit spreads, speculation in the stock market, and so forth. Well, this one here tries to put it all together in a kind of a composite ratio of things you would buy if you were wanting to take risk against things you would buy if you didn't want to take risk. So when you don't want to take risk, you buy things like bonds and gold and the Japanese yen and so forth. And when you want to take risk, you buy things like mining stocks, other than gold, technology, and so on and so forth. So I combine this into two indexes, a risk-on index and a risk-off index. And the green highlights, once again, with the benefit of hindsight, show you sort of extended periods when the ratio is rising. And usually when the ratio is rising, you look at stocks are also rising as well. And if the ratio is falling, that's when we get one of these white areas. And typically, excuse me, if you're going to get a nasty correction, it's usually when the risk-off is beating the risk-on. So once again, we're looking at this trend line here, goes back to 2008. It's a 10-year downtrend line, been touched on several occasions. So it represents a pretty good trend line. And what we see is a major breakout that's taken place on this risk-on, risk-off. So basically what we're seeing is that whichever way you look at it, whether you look at a multi-asset relationship like this, inter-asset, stocks against bonds, credit market spreads with bonds themselves spilling over into stocks, and also in the stock market itself. All these ratios are looking like they're breaking to the upside, and they have broken to the upside in the vast majority of cases. If they start to break to the downside, that would be a totally different matter. But even you can even take this abroad. Now this, oh no, I just have one other chart to show you with the risk on, risk off. From the previous chart, I've just shown you this in greater detail with that discrepancy that I mentioned before, where the S&P made a new high and a lower high, and the risk on, risk off made a higher high. Hardly any kind of a correction took place at all in the ratio, which I think is very positive. One chart I was going to show you again it hasn't broken yet, but this is frontier markets against emerging markets. I regard emerging markets as pretty speculative, frontier markets even more speculative. It hasn't broken out. Frontier hasn't yet broken out against emerging, but it's very close to. And you can see the momentum in the bottom with the short-term KST, the intermediate KST, and the long-term KST are all in a positive mode. So that suggests to me that this ratio is likely to break to the upside. But until it does, it hasn't done so. And we can't say that it has until it actually has. But it does look fairly encouraging. It's certainly not the kind of picture you would see if you were expecting the whole global market structure to fall apart here. This is much more akin to another up leg in the global bull market than this character of this relationship than it is to a falling stock market, global market. Just to show you a few charts now on a couple of these sectors that I find interesting. Spider housing here has broken below its early February low. One of the few industry groups that's done that. It's also broken below this uptrend line going back to late 2016. More to the point, though, its relative strength line has also broken decisively to the downside. And if you look at the relationship between the relative strength and the price, usually what I like to see is when the price makes a new high, I like to see the relative strength making a new high too. I like to see everything in gear. But in this case here, housing relative strength made its peak back in 2015, and its good rally that it saw in 2017, 2018, was not enough anywhere near to take out that previous high. And that's important because housing industry is the most one of the most interest sensitives that we have, and interest rates tend to lead the stock market, and housing tends to be a long leading indicator for the stock market. Tends, I say that because it doesn't always lead, but when it does start to deteriorate, it always gets my antenna up, as this could be an very early bird warning for the overall stock market. So regardless of that, it looks like housing is not doing so well, and it's also broken below this previous low here. So it's one of the few sectors where we've seen a new low. Another ETF, which I think is an interesting point, not quite so badly deteriorated as the housing, is the power shares building into construction. Again, a related ETF in terms of what it does. It's right on its trend line, and you can't see the 65-week exponential moving average, but it's right at that. In the final charts I'm going to show you, all have the same template where we look at the price at the top. Underneath, we have the long-term KST, which monitors the primary trend. The third panel shows you the relative action against the S&P, and the lower panel shows you the relative momentum, which is derived from this third panel here. So ideally, you want to see everything in an uptrend, like you were here, with the price above its moving average, the long-term momentum for absolute price in a positive trend, the relative strength, and the relative momentum all in a positive trend. Right now, the relationship between the relative strength of the PKB has just broken this long-term trend line. That trend line goes all the way back to 2011. It's broken below it. It's also below its exponential moving average. Also experienced a false upside breakout. Whenever I see a false upside breakout, I expect to see an above-average move in the opposite direction. This is an up move, so the move I expect to see was more of a downdraft. The relative momentum is also negative. So although the price is still an uptrend here because it's above its moving average and above the uptrend line, it's not somewhere where I would want to be investing right now or trading. because the relative strength is in a negative mode. If the relative strength is in a negative mode, there's better opportunities elsewhere. So next chart is more bullish now. We're looking at the biotechs, the FBT, broken above this base or consolidation pattern. The momentum is positive. The relative strength has also broken out, and the relative momentum also looks pretty good. So we give good marks here to the biotech area. Next chart shows IGN, which is the North American Tech Multimedia Networking. This one here is really starting to take off with the sparkling new high this week. Relative strength breaking this downtrend line going all the way back to 2011. Relative momentum is not yet bullish, but it started to turn, and if this breakout is worth its salt, that I guarantee that momentum is going to start to turn fairly soon. So tech multimedia networking looks pretty interesting to me. Here we're seeing the PowerShares Dynamic Media Portfolio, PBS. It's broken out of a consolidation pattern and moved to marginal new high this week. The relative strength is just starting to break through this 4-year downtrend line, and look at the momentum has just started to turn up again. So I think with that I'll just show you steel, which this is the SLX, the VanEck Vector Steel ETF, which is broken above this resistance line here and above its moving average some time ago. Momentum is positive, and the relative strength is also positive, and the relative momentum is also above its moving average. So that looks fairly interesting. Although it hasn't responded positively from the new tariffs that are proposed to go in. So that kind of worries me when a stock, or in this case an ETF, doesn't respond to what is presumed to be good news. So that's something worth watching on the shorter term chart. So with that, I'll wrap up and turn it over to you guys for questions.
Well, it's interesting you brought up steel. We did talk about that yesterday and asked the question of the audience and ourselves whether we were bullish or bearish on steel going into 2018. I was the only bullish one. Tom and Greg were both bearish, as was the audience. So we'll have to see what happens as we go forward.
Yeah, but don't you find it strange that it didn't respond that well to good news?
Absolutely, and that is worrisome. But I think there's still a lot of technical strength in there, so we'll just have to see how that.
Yeah, I mean, when we're looking at that chart, there's no way you could be bearish, really. But
right. Well, that was my opinion anyway.
I'm afraid to speak now.
Also, I have to bring up I think your first VIX chart. You had an inverted scale for your VIX.
Yeah.
Yeah, I use that, and everyone gives me a hard time about it. So now I'll just tell everybody, well, Martin Pring does it.
Must be right.
Yeah, I use it as overbought, oversold, so I find it easier to flip it. So
yeah. I think from the steel perspective, my biggest problem was that we're getting close to multi-year resistance on the steel index, the DJUSST. So I like the short term, but the question was whether or not we would see strength through the balance of 2018. And I just need to see that breakout above. I think it was like a 2011 high or something. And so I'd like to see that area cleared prior to getting overly bullish. And also the long-term relative strength going back throughout this bull market in steel has not been very good, even though we have seen a pickup of late. So those were some of the arguments against it. But
yep.
Well, maybe the steel index and the SLX are different. They got different components.
Yeah, I think they do. They definitely do. I wanted to bring up one chart, though, because you did mention the housing stocks and how that can be a leading indicator. And I just wanted to maybe drive that point home for everybody. So let me pull up a chart. I've got the DJUSHB, which is the home construction index here on top. And then below that is the home builders relative to the S&P 500. So this home construction index relative to the benchmark. And then I've also got the 10-year Treasury yield. And you can I see some similarities, but I also see a couple of key differences, and I'd love to get your thoughts on this. But first, back in 2005, your comment was right on. I mean, here we saw the home construction index top 2 years before the S&P 500 did, and we started making our way down. And you can see on a relative strength basis, we made a clear breakdown of that relative strength that we had heading into 2005. And also the 10-year Treasury yield back then. I mean, it's kind of hard to remember that the 10-year Treasury yield actually went through periods of higher yields. But here from 2003 to 2006, you can see that the 10-year Treasury yield did make its way up above 5% at that time. And you can see what happened later with the home construction. And of course, the S&P 500 followed it. Now, I do see some differences here. And that being number one, I feel like we're kind of, we're about where we were over here. We haven't seen a price breakdown in the home construction index. I mean, we can look short term and say, yeah, there are all kinds. But I think when you step back at the big picture, I see an index that broke out of sideways consolidation and is really getting its first pullback after this move to the upside. It is coinciding with a move higher in the 10-year Treasury yield, but we're looking at 2.86% instead of 5%, which I think is a big difference. And then also the relative strength in home construction did make a multi-year high, basically a decade high on this last push to the upside. And I'm just questioning whether or not this might just be a little bit of profit taking and maybe longer term home construction still okay. But what are you seeing from this chart? Anything else?
One question: why didn't you invert the TNX so they all go up and down the same?
Because I don't. I don't invert anything.
Oh, you don't? Okay. So yeah. If Erin was putting up this chart, she'd invert the TNX.
Have it inverted, yes.
Probably yes.
No doubt about it.
Overbought, oversold. That's my old brain. It's, overbought is at the top, oversold's at the bottom. So sometimes I just have to invert it.
But I guess my question, Martin, here, are you giving up on home construction at this point, or is it just a little bit of a red flag?
Well, why would I want to be in home construction when the relative strength is tanking?
Good point. Last couple of months, you certainly wouldn't want to be in home construction. But I guess from a longer term perspective, the fact that the relative strength is still much higher than it was, say, 15 months ago, I'm just wondering if you've written off the group or if you simply are just waiting to see relative strength before you'd be interested in it again.
I would want to see that when I would look at something, I want to see the long-term momentum relative strength bottoming out and turning up. And I want to see some evidence that that's confirmed by the price, the relative strength price.
Right.
Because you can't buy and sell. Well, I guess you can't buy and sell relative strength, but if the relative strength trend is agreeing with what the momentum is doing, then you have more pieces of evidence moving in that direction.
Gotcha.
I must admit, your chart doesn't look as bearish as mine, and you're looking at the index.
Yeah, I'm looking at home construction index.
I was looking at the XHP, so there must be a difference between them.
Yeah, I think home construction I think it includes maybe Home Depot and Lowe's.
Oh, well then you compare that to the ITB then.
Right.
Dow Jones, and that's not as bearish as the
XHP.
The XHP. The XHP is well, you saw the chart.
Right. Yeah, I saw it.
But the ITB is nowhere near as bearish because it includes Home Depot and so forth.
Okay. Good point. All right. Well, any other questions in the room, Erin?
Let's see. I know that there was questions about whether for the KST, do you have different defaults for your intermediate term, like a weekly chart versus a monthly chart? Do you use the same KST parameters?
We use different parameters depending on the time frame.
Mm-hmm.
And so for monthly, for example, we use 24, 9, 12, 18, 24 months rates of change. But if we're doing it on a weekly chart, we just do the equivalent of that in weeks. So in other words, it's 4 weeks in every month, we'll say. So 4 times the parameter. Unfortunately, it's not one of those things where you can just put a number in and plot it and change the number. It's designed, the way it's designed is it's designed for specific time periods, like intermediate trend, short-term, or long-term trend.
And then the last one was what your trading style is. Do you still do a lot of investing, short-term horizon, or what's your style, short-term?
Well, I don't. I used to run what they now call a hedge fund, and get quite actively involved. But now I'm involved with Pring Capital, and we have the SEC looking over us, and we have to go through a real rigmarole to be able to buy or sell anything. So I just let my partners run my money, and I concentrate on the analysis.
All
And I
right.
find also it helps because it makes you a lot more objective. I see a market going down 800 or 900 points. It's beyond my control, so why worry about it?
Right, exactly. All right. We have, there's a lot of questions like what you think of the
They
top.
also do a good job too, so that's the other.
Yeah, exactly. Well, before you go, I did want to mention that Martin is going to be at ChartCon, and I'm going to show you the link real quick for that. But I know you could probably state as well as the rest of us how enjoyable that was to do it. But really, one of the fun parts was the VIPs that came along and we got to talk to. So
Yeah.
I know that we don't hide, so we're around. Even when we're not presenting, we're happy to say hello. That's kind of what we do.
We had some good evenings with some of them, didn't we?
Yes, we did have some very interesting evenings. So if you're interested in joining us in person at ChartCon, they've extended the signups to March 31st. So I recommend you check that out. But if you're just interested in hearing what we all have to say, it is an online conference. So you can register and then you can sit in the comfort of your own home and watch the presentation. And then you also get to have that archived as well to rewatch later on. So anyway, I just wanted to mention that before you left because we try and get the guests that are going to be there to talk a little bit about what they do and how we work the ChartCon. So
we're looking forward to seeing you again in August, Martin. That'll be fun.
Same here.
Absolutely.
Thanks again for joining Market Watchers Live. It's always a pleasure to have you on here, and let's do it again soon.
It's been great. Thanks for inviting me.
Oh, you're very welcome. There he goes, Martin Pring, one of the technical analysis giants out there.
Tech Titan.
Yep, always love to have Martin on the show. A lot of great insight, as you just saw, a lot of intermarket relationships, which I think is something that just isn't discussed enough. We're always talking about, oh my goodness, the Dow dropped 900 points or went up, did this. But I think a lot of the charts that Martin showed, it doesn't really paint the same picture as the market dropping, where you still see money rotating into more aggressive areas despite the selling that we've seen. The lower highs on the S&P are not matching up with lower highs on other aggressive related ratios. So I tend to agree. I think that I'm looking at more bullish outcomes at this point. Clearly, that isn't confirmed until we get a new high, but you got to be open to the possibility of being wrong. But I'm just not seeing too many negative signals. So with that, I guess it is time. Let's move on to the 10 and 10. What do you have on the RRG there, Erin?
Well, I'm actually inputting it, and this is a great exercise so you can see how easy it is to add charts to a chart list. If you click on many, you can just throw these in here with just a comma in between, and we'll see what we have. I was busy checking out the chat room here, and I didn't get these all in. So right now we've got about 24, and let's go ahead and look at that RRG very quickly. All right. Really, I always find it interesting to see these outliers relative to the S&P. So further away it is, the more it's really not traveling with the S&P as far as it's doing better or doing worse. We'll have to take a peek at that, but very interesting. We'll have to see what we've got coming in here. But if you go down, we're looking at TWLO, Light Fay, PSP. These are all in that improving category. So we might look at a few of those. But let's go ahead and start with the very first one, which was RLH.
All right, RLH, which is Red Lion Hotels. Let me grab the screen, and we will get started here. Okay, so we got RLH. I think currently it's in a downtrend, but I'm not ready to totally give up on it. It is still holding on to price support. So let me annotate and show you what I'm referring to. Here was a breakout above about a 920, 9.25 area. You can see the volume picking up here as we made the breakout. So far, we've been holding. We did pull back and test that level again just the end of last week before rallying back to the 20-day moving average. I could make an argument that we have a bullish wedge in play here on our LH. And the way I would construct this is to connect the highs and to connect the lows. And essentially what you should get is like a piece of pie where it's getting tighter and tighter as you get further out. Now, some of them are a little bit more obvious. This one isn't quite maybe as solid as some of the other bullish wedges I've seen in the past, but I do think off of a straight move up on very heavy volume, this has been about 7 weeks worth of consolidation. And I think a big volume break of this downtrend line would be very bullish. So I'm still holding out hope, even though it's been a rough 7 or 8 weeks. I'm still holding out hope that this one breaks out, makes another run toward those highs.
Excellent. All right, so let's make the next one. A lot of people wanting to see NVIDIA, so NVDA.
All right, yeah, NVIDIA I think looks great. I think it's in a really nice pattern, continuing to see the higher lows print. On a relative basis, it's in a very strong area of the market, of course, within technology, semiconductors. And so I think it's just a matter of time before we get another breakout here. The level to watch to the upside is clearly the 2 recent highs. So if we pull up the auto support resistance, there was the first high, and then there's the second one right there, the top of that red candle. So I think 246 up to about 251, 252 is an area where you could see some selling, but a breakout above that with increasing volume, I think would be very bullish. So I'm still bullish NVIDIA. Again, it goes along the lines of just being bullish the overall market at this point, and NVIDIA being in a strong area within the market.
All right. Let's see the next one, also popular, JD.com. So JD.
All right, JD. Well, we're at a key support level. I mean, it really needs to hold, and there is a lot of volume that's been coming into the downside here. So I would kind of like Martin said a little earlier, kind of got my antenna up right here. But I'm going to draw these 2 lines. Here was the recent low close, and then prior to that, we had a nice gap up on heavy volume, and there's the reaction low. So I could give it 41.5 to maybe 42.25 down here, which is where you see these tails and prior turns back to the upside. But that's where I would want to maintain my stop. I think if you get much below that 41.25 area, certainly 41, and more importantly on a closing basis, I think that would be very bearish.
All right. Let's see. The next one I'm going to give you is Adobe.
Yeah, I love Adobe. Without even pulling up the chart, I already know I love it. It's in a great space. It's been a great performer. You got the PPO still rising. I mean, just take a look at what this chart is, what this company is doing from a price perspective and what the benchmark S&P 500 is doing. I think most who follow relative strength would look at this chart and say, what's not to like? You got the PPO again rising. The last pullback held the rising 20-day moving average, and it also held price support. That was prior resistance, and broken resistance becomes price support. That's kind of TA 101. If there's one negative to this chart, I would have liked to have seen a little bit more volume on this breakout, but I don't have a negative divergence, and I am continuing to perform very well on a relative basis. So I'm a fan. I like Adobe.
All right. Let's see the next one. Ferrari. Race, R-A-C-E.
Yeah, one of my favorite ticker symbols.
Mm-hmm.
But of course, ticker symbols don't make you money. I think it's in a sideways rectangular consolidation off of an uptrend, so I'm bullish the stock. I think that 50-day test was nice. We had a negative divergence in play. Let me annotate, show you a couple of these things here. But first, there is your resistance. You can see it's pretty clear around 131. Recent lows, you can see right there. Could draw it from the gap support. Let's just go ahead and use it there. I think if we go much below about 119 on a closing basis, certainly 118, I'd be concerned. But off of this uptrend and the huge volume move on the last push to the upside, we did go all the way back down, fill this gap, made another run right back up toward that 130 level. And I think now we're just consolidating here sideways. But I expect the next move to the upside to occur relatively soon. So I'm a fan. I like race.
All right. Next one, Canfor Corp. It's a Canadian stock we're looking at, CFP.TO.
Okay. Well, we're continuing to put in the higher highs and higher lows. A lot of volume coming in on that last break below the 20-day. So maybe getting a little nervous about that. But we are continuing to put in the higher highs, higher lows. There was your breakout on heavy volume. You can see that's been holding, continuing to move up. But if there was one concern, it would probably be the negative divergence, where from this high right here up to that high. And by the way, look at that big reversing. I don't like those long tails to the top, especially when you've got a negative divergence in play. So I think that we maybe just got more sideways consolidation. I would even draw one more support line. I think the most recent low needs to hold right there, because you do have a negative divergence, which means 50-day tests certainly more possible at this point. So I think you're going to be between about 28.25 and roughly 31.5. If we were to go down close below 28, that's giving up this price support and the 50-day. I would be more concerned, especially if the volume continues to pick up. Otherwise, I think what I expect is more sideways consolidation, and ultimately, maybe we'll get down to that center line test on the PPO, and then I would look for momentum to resume back to the upside.
All right, let's see. The next one I have is, let's see, IPG Photonics, IPGP. Big old symmetrical triangle there, at least on my chart.
Yeah, I see it as well. I mean, this one candle kind of sticks out. But other than that, yeah, I agree. I mean, you've got the lower highs coming down, the higher lows going up. You got higher highs and higher lows. So you got an uptrend in play. I might keep an eye on the trend line that, more the longer term. Well, in my view, longer term. Of course, we know my long.
Your horizon's a little different.
Yeah, doesn't quite fit with everybody else's, most everyone else's. But yeah, I mean, I think you got a pretty solid trend line there. We've had multiple tests, as you can see. I mean, the strength of a trend line is based on the number of tests that you have along it. If you have connecting 2 points, we can do that anywhere. But if you've got 6, 7 tests like this, I think it becomes pretty important. So I think that trend line, along with maybe the most recent low, is really an area of support that we want to make sure continues to hold. So I think the biggest area is going to be from 227 up to about 237. I'm going to grow a little more concerned if this trend line here is broken. Probably would lead to a test of the 227 area, but it is still putting in higher highs and higher lows. So I'm going to take a bullish position on this one. I think it goes higher.
All right. Let's see. Let's go with that one that was kind of an outlier on that RRG, TWMJF, Canopy Growth Corp. It's, I think you can guess.
Okay, well, it is over the counter, so not quite as highly regulated. I tend to stay away from over the counter stocks, but I do like the breakout of its recent downtrend. So technically, if I'm just ignoring the OTC part of it, and I just look at these tops coming down here, I think clearly, and maybe you could almost make an argument for a triangle here as well. I won't change the color just to keep the pace up. But here you can see off of a prior uptrend, clearly we are squeezing into a triangle. We made a breakout. Volume's been picking up. So I think this one's got a shot to make another run up for that 35 area where it topped back in second week of January. To the downside, if that's true and we are starting a new uptrend, then I would look for this rising 20-day moving average to continue to provide support.
All right. Number 9, Key Corp. KEY. I like this chart. I got a PMO buy signal.
Yeah, I like it, although I'd like to see strength into the close. I don't like that tail trying to make the breakout. If it fails, I still like it. I just wouldn't be a buyer. I'd wait and see maybe if you get a 20-day test. You got a nice trend line coming up here. This could morph into an ascending triangle. So this would be A, B, C. One more time down would be D, and then we could get off, be off to the races. So I think today's pretty big because we do have decent volume coming in. We had the breakout earlier today. If we fail to hold it here, I would look for maybe one more pullback, but I do think eventually we're going to get the breakout here. And by the way, there's one of those false breakout tails. That's the part I don't like. When I have a breakout intraday and then I fail, you can see what happened here. So we don't want to see that same scenario develop.
All right. Let's see, last one. Let's do Andeaver, energy exploration. So ANDV.
All right, last one, ANDV. Wow. Really hard to get behind this one, especially with that candle today. I do not like that at all. Anytime you get the PPO going down like this on these lows and you come back up and you fail at the 20-day moving average, I assume we're going to get another push. If there's one positive here, I do like the volume that's coming in off the bottom to test the 20. I think if we go down one more time, you can see the PPO is certainly taking a move up to the upside. I think if we go back down and with light volume, move back down just below 90, we could potentially be setting up a positive divergence. So I won't totally give up on it, but you can see the volume. I mean, this is a stock that moved from 120 down to 90, losing a quarter of its market cap in about 5 or 6 weeks, and doing so on very heavy volume. It's hard to argue that that's distribution. I think that is clearly distribution. And so these moves back up, these reaction highs, for me, I don't trust them, and I definitely don't like that tail being above the 20. So unless we finish strong today and can clear the 20 on the close, I would pass on this one.
All right. And that is the completion of the 10 and 10. And with that, I'm going to, let's see, we should have our symbols up here. There they are. And I will get those up in the MarketWatchers live blog chart list. So just go to the blogs tab, look for the MarketWatchers live blog, and you'll see the link to the MarketWatchers live chart list where you'll have all of these symbols to look at. And speaking of Tom and his symbols, we're getting ready we're in the middle of doing a poll right now for Tom to, a subject for Tom's workshop tomorrow. He's offered up, some ideas. And so if you want, go in there and take the poll. I'll show you really quickly where you can do that. And so far, it looks like establishing a strong earnings chart list is leading the way.
Yeah, I had a number of comments and suggestions through the survey and a couple emails. So I want to thank everybody for that. And all these we'll take a look at in time. But for a topic for this Friday, we'll go with whichever one wins. So you've got probably another 15 minutes or so, 13, 15 minutes to cast your votes. And whichever one wins, we'll take a look at on Friday.
Absolutely. And I'll show you just really quickly here how to get to our polls. So here's that chat box on the right-hand side of the show. And just go in here and you can put in your name. If you put your email in there, we'll try and get back to you for questions. Can't promise anything. But just click here to polls, and there you go. And you can pick whatever you'd like to do. I'm not going to pick. I'm going to leave that up to the viewers. I think all three would be very interesting. All right. And with that, I think I'm going to go ahead and move into our final market update, and then we can look at some technical scans. Let's see. All right, let's go ahead and refresh. All right, so certainly not a great day for the markets. Looks like, we tried to make a move back up into positive territory for the Dow earlier in the morning and for the S&P 500, but we're now starting to make some new intraday lows. And the NASDAQ, though, isn't getting hit quite as hard, but also in the negative. And small caps staying on the positive side right now, up just slightly, but really traveling mostly on the upside here. The TSX, Canada's market, we're seeing, wow, look at that really nice move up, but it just crashed down and we're now back flirting with intraday lows. We can see Treasury yields are down somewhat, currently reading 2.86. And we've got TLT. I decided to add that one in, and we can see TLT is up, a bit rather choppy trading, but all on the positive side. UUP is up slightly. We can see that commodities and oil are both down quite a bit. USO falling to 1225 right now. We see GLD also in the negative, but trying to make a move back up from its intraday lows, currently reading 125.75. And the VIX is higher so far. We did have readings up toward 20, but we're back down to 1935. Elevated though from yesterday. Go take you to our member homepage here for our market summary. Take a look at how the sectors are doing in the industry groups. And you had mentioned, Tom, that all of our sectors were negative. Let's see if that's the case still. It is indeed, with technology and healthcare not failing quite as much as the laggards of consumer, discretionary, and energy. Interesting, though, Tom, to see both staples and discretionary down about the same amount.
Mm-hmm.
We can see that REITs are positive right now as far as industry groups, network, transports, and the laggards right now, oil services, gold, and natural gas. The international ETFs, Italy and Germany are the only ones on the positive side. And we can see as far as laggards, the worst ones, Brazil, South Korea, and Hong Kong having some difficulties today. And with that, I'm going to conclude our final market update. And did you have anything you wanted to add, Tom?
No, I think we're good. I know you got your technical scans, so I think go ahead and show some folks how you for some candidates.
All right, let's get to it. I'm just going to go up to our, you can see all the various things I've been looking at. So I'm just going to our homepage here. And, you know, I talk about my scans a lot, but I wanted to show everybody a little bit where you can find some of the predefined scans and alerts. So the predefined scans are in here already set up, and they're even separated out by market and mutual funds. If you want to look at which ones already are strong volume gainers, et cetera, et cetera. You can also go down for the bearish views, and you can come down to candlestick patterns. These are all available to you. Let's just take a quick peek at this particular scan right here. 55 entries and pretty easy to get to. So I'm going to take you to one of my scans, though, that is very popular. And I do have the link at the bottom of every MarketWatchers live blog, so you'll want to take a peek at that. But this is my PMO scan that I run for Monday setups. And I just wanted to show you exactly what I'm looking for. These aren't really that hard to come up with, but this one, if you want this exact one and then you want to tweak it a bit, go right ahead. Like I said, the link, in fact, I'm going to go ahead and show you guys where that link is. Let's do that right now, because I think it's important. You guys should know where this MarketWatchers live blog is, because I don't think a lot of people take a peek at this, especially those of you who watch the show might find it very helpful, especially if you're watching later. So here's where you can get to our MarketWatchers live chart list, and that has all of our 10 and 10 symbols in there. And like I said, if you check our MarketWatchers live blog entries every time, I have our weekly schedule in there, what we covered. But I think what's really helpful is I do have timestamps in here. I am trying to get Martin Pring's charts, and I will set these up as clickable links if I can, so that you can go in and look at what our presenters or that we presented. So the other thing is, at the bottom of all of these blog entries are the helpful MarketWatchers live links. Takes you everywhere from Tom's blog to my PMO scan to some of the indicators that we often use here. So, as well as where you can find our archives of the shows. Back to the scanning, though. Here we go. So what I like to look for, first of all, in this case, I'm scanning just the S&P 500 and 600. You can, of course, fit this to be whatever you'd like. If you want just the TSX stocks, if you want just ETFs, there are various ways you can change these. And in the workbench, it's really not too hard to do that. So you can say, okay, let's look at only the exchange traded funds, or don't include those crazy inverse hedge funds, and that's really easy to add. Just click on it, and it'll add the actual language right on in here. So I like to look for momentum movers that are just shifting their momentum from negative to positive, but haven't had the buy signal yet, because I want to get a jump on it somewhat and see what's going to happen. And so what I watch for is a PMO that has been rising for the last 3 days. So that's what I'm looking for, those reversals. And then I do like to have a positive lineup of the EMAs, with the 20 above the 50 above the 200. And it looks like I might have modified this one a little bit and taken out the scooter, but I do include the scooter as a scanning element, and that is in the scan that I shared with everybody, that link, so you can find that. But a lot of times I might cancel this one out if I'm not getting the kind of readings I want, or if I'm getting too small of an amount of stocks. I will go ahead and reduce the scooter value, or I'll just edit it out by adding the remarks symbols there. And that way the scan engine does not read this particular line. So that's one way you can quickly get out of there. So this is the scans I use. Now, if you go into the scanning workbench and come down here, these links are absolutely, you really need to check them out if you have not checked them out, even if you've written some scans before. The scan examples, it tells you all about what the sample ones are, how to get to the user contributed scans. In addition, the writing scans is extraordinarily helpful. It talks about the scan clauses. Here is the outline of all of the different things you can add, what kind of operators you can use, some of the expressions, and also links to some of those sample scans in here as well. So don't be afraid of scanning. Now, honestly, it is probably the most useful tool that we have on this website. And if there was something that they told me I couldn't give up, besides that I had to give up everything, I would probably give up I give up everything but the PMO and the scanning, because I just, for investments, research and that sort of thing, they're critical to me. So I'm going to take a peek really quickly here. We've got a few minutes. Let's just see what my scan is pulling up right now. Earlier today when I ran it, it came up with about 30, I think, 33. So we're going to look at this right now. All right, only 7. Actually, no, that's right. When I ran the other one, it was 33. This one came up with 7. So it looks like it's the same ones. And I had saved these into a what I call a scan dump, where I basically replace a chart list, and I've named it scan dump. That way I can go in there and look at all of the things. I can manipulate it, but this is probably more of a temporary chart list. So again, one of those ways to get away from that analysis paralysis, move things into places, and then, put everything in the scan dump. And then once you find the things you're interested in, add those to a chart list. So right now I have these 7. I'm going to take a peek at them in Candle Glance. That's what I usually do to narrow down what I think looks good. And just looking at this, the PMOs right off the bat, I'm interested in this one because we're getting a PMO buy signal. This one, double bottom on the PMO. We are getting that buy signal, but flat and trending lower, not interested. Flat across. So these would be the ones I would probably be interested in right here, would be G3. And I think I looked at this one before. And you can see it looks like the PMO is turning down, though. It wasn't doing that this morning when I was looking at it, but I'm not too concerned about that at the moment. But I would be watching this one and seeing if we do get that PMO to continue on up with this rising trend that we're seeing right here. So I like the fact that honestly it is down. It could be offering an opportunity to get in, but beware of that 50-day EMA. I think that's really the critical point at this point. And I think Qterra was the other one we were looking at. Yep. And healthier PMO, I would say here. And yeah, I'm liking the breakout here. above this area, we saw a consolidation, and now we're getting that move up. Look at the 20-day EMA is now turned up and moving away from the 50-day EMA, just got a 520-day EMA positive crossover. So this one's looking pretty good coming out of my scan. So that pretty much concludes my technical scans, and I think there might be a summary slide here showing some of the symbols I went over, but if not, I'll certainly have the summary for you in the MarketWatchers live blog, and highly recommend you go check that out.
Excellent. Yeah, I was looking at a couple of these when you were going through them. I think that CUTR looks kind of interesting, although it might be a little light volume for me. I think it's 76,000 shares today. But yeah, it's coming off of some pretty good support around 44, 45 area and trending up nicely. And I know Crocs, CROX. First of all, I like the footwear space, so that one
That's right.
would get my attention. But it may be having some short-term difficulty trying to get through gap resistance.
Yeah.
Had a huge gap down about a week ago on very heavy volume. That's that big volume bar that you see, and yeah, that you're pointing at there. And so we've come all the way back up, literally right to that close right now. So Crocs, I think, will be pretty interesting heading into the close. But it's got a nice long-term uptrend in play, and triple bottom going across recently here in 2018.
Here's proof that, like you didn't know, but the PMO isn't 100% here. We got that buy signal right before that gap down. So, it happens. It doesn't always work, but I do like the fact it's coming back up. But yeah, I'd want to watch that 20 for sure.
Yeah, right. Nothing in technical analysis works all the time. I always say that the only guarantee I'm aware of in the market is that there are no guarantees.
Absolutely.
It's the way to look at it. All right, so what do we got for the poll? I know we got just a couple of minutes left and got to figure out what I got to talk about on Friday. So, wow. Away.
I think it's pretty much determined for you. I'm interested in seeing how you do that as well. So, because I know you create that, but then you run your scans off of that too. So you're only looking at a universe of stocks that you're comfortable with and know are already set, right?
Yeah, and I only trade. Well, I won't say I only trade, but primarily I only trade stocks on that chart list because to me, it gives me confidence. I feel like companies that are beating top line and bottom line estimates are among the types of companies that I want to buy. I think when you get companies that are routinely missing top and bottom line estimates, I think it does leave a question mark out there for portfolio managers and so forth who are, you're looking at their guidance and you want to believe that their guidance is true, but when they come up short, I think it does create some confidence problems when you invest. And of course, if the market starts pulling back, or if that particular stock starts pulling back, and it has a history of maybe not being the best in terms of meeting its estimates, then you got to wonder, does somebody know something? Is the next report really going to be bad? But I think it was Mark Chaikin when he was on talking about how he, has his fundamental approach that he looks, and it gives him a lot of confidence getting into these stocks, especially after they've pulled back. And I would say that almost parallels what I try to do with this strong earnings chart list and buying on pullbacks. So it'll be a timely topic for sure, but I don't think anyone realizes, everybody who's voted for that, you have no idea. You must be gluttons for punishment because there's a lot of homework to do. I'll be happy to go over it and show you how I go through it, and that's what we'll do on Friday.
Yep. We got a question in here that's kind of interesting. Do you feel we're gonna? Do you still feel we'll retest the February lows? I think we will. There's just too many bearish characteristics or implications that I'm seeing in my indicators, etc. Oh, there we go. There was some technical scan information. But anyway, it looks like we're getting ready to close up the show. So we have to thank Martin again for coming in today to talk to us. I highly recommend you go check out the archive or rewind and rewatch Martin's segment. But tomorrow we have Tushar Chande is going to be coming in. Friday, it looks like Tom's workshop is going to be on creating a strong earnings chart list. So should be a nice finish to the week. And I know we're getting geared up for a great week next week, but we'll let you know more about that on Friday.
Yeah, and getting back to the question about whether we're going to double bottom, you know, it's still open. It's still possible. I don't think we're going to. I don't think we're going to go back down there just because I see too much money rotating towards aggressive areas. And I think the closer we get to the next earnings season, history tells us the market tends to move up in anticipation of higher earnings. So I think we're running out of time. And I think the confirmation for me that we're not going to go back down there will be another low on the VIX that takes out the low we saw about a week and a half ago, down around 16. I think if we move below 16 again, then I think the worst of the selling's behind us. Just my opinion.
Yeah.
But yeah, that is pretty much a wrap. Again, want to thank everybody for stopping by and being with us today. It was awesome having Martin Pring back in, and I'm sure he'll be rejoining us again some point in the future. Please remember to complete that survey as you exit. Bottom part of your screen underneath the chat area. Just click on that link beneath the How'd We Do section and fill out the survey and let us know what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow on Thursday. Happy trading.